Good morning, it's Jeffrey Christian, CPM Group. It's just after 10 o'clock on Friday, the 13th of January here in New York. I wanted to talk to you about inflation. The December U.S. Consumer Price Index data came out yesterday, and it has some interesting information in it. Gold and silver prices initially rose sharply in response to that, the CPI release. Gold is right now trading a little bit above 1900, and silver is trading a little bit below $24 an ounce as a result. CPM Group's view is that the prices have risen very sharply in the first 2 weeks of the year. There's some short-term profit taking that could come into the market today or next week. Our expectation remains that the price will move sideways for much of this year before starting to rise. But we'll talk about that a little bit later. First, again, I want to go back to the dollar. I've used these two charts now for several videos, and we keep hearing about how the dollar is going to collapse and how it's falling sharply. It has, in fact, fallen 7% from its intraday peak to its intraday low on a trade-weighted basis from November into January. Prices, the dollar's exchange rate has fallen on a trade-weighted basis all the way back to where it was in August, 5 months ago. If you look at the longer-term price chart, and this one goes back to 1970, the dollar was freed to float in 1971, you can see that that 7% decline in the dollar's exchange rate hardly shows up. And it's still much higher than it was for most of the period from, say, 2021 into August of 2022. So the dollar is not collapsing. You keep hearing this, and I'm a little bit surprised. It's a turn of a year, and you hear the same people saying the same thing that they've been saying at the beginning of the year for as long as they've been in this business. Some of them have only been in the business 1 or 2 years. Some of them have been in the business 30 or 40 years, and they keep talking about how the dollar is going to collapse and how there's a concerted effort among developing countries or the BRIC countries or other groups to replace the dollar with a gold-backed currency, none of which is true. There is a desire to diversify away from the dollar, but central banks, generally speaking, have about 60% of their foreign exchange reserves in U.S. dollars, and there's a variety of reasons for that. And most central banks are not adding gold to their reserves. There are about a dozen or 24 central banks that are, but they're adding gold in relatively small increments in terms of their total monetary reserves. The dollar's not collapsing. You shouldn't hold your breath. You shouldn't race out and convert all your dollars into gold because they'll be worthless tomorrow. It's just not happening. But that's not what I wanted to talk about today. I wanted to talk about inflation. We had the December contract come out, data come out for the December changes in the U.S. Consumer Price Index. This chart shows you the 12-month rate of change, and you can see now the headline inflation has been falling since June, so 6 months of declining headline inflation. That's got very volatile food and energy prices in it. If you look at core inflation, less food and energy, it's been falling now for 3 months. So we are, in fact, seeing some of the cyclical and short-term trend factors that have been pushing inflation higher since March of 2021 now dissipating. But take a look at it. I mean, we're still at like 5.7% on core, and about 6.4% or 6.5% for headline inflation. You still have some long-term and special event factors that are driving inflation up. If you look at what the components of inflation, the big increases inflationarily have been food last month, heating oil, wintertime, and a cold December it was, and services. Non-food and energy goods actually were rising about 0.2%. non-energy services were rising a little over 7%. So we still have factors that are inflationary, and we still have factors, where the deflation pattern has come off. And if you look at it on a month-to-month basis, which is much more informative in my mind because it shows you what actually was happening in December, we had a 0.1% decline in the overall consumer price index. The first decline since May of 2020. And you can see here again, since June, we've entered a new period of time with lower month-to-month inflation rates. So the anti-inflation battle being waged by the Federal Reserve Board is showing progress. It's a slow progress, which is what reasonable people have been saying, and it's going to continue. I have another chart on consumer prices here, which is again the month-to-month changes, which was negative 0.1%, just below that black line at 0 in December. And you can see how rare it has been for the consumer price index to actually show a negative figure. The last time was during the height of the pandemic lockdown. There was another time around 2015 or so. And you can see it's just not that common. So we are seeing a shift in the inflation rate. Now, what does that mean for gold and silver? Well, first off, how does it mean anything for gold and silver? Well, the major, there are several factors. First, inflation in and of itself. Those people who have been talking about hyperinflation, and real economists define hyperinflation as like 50% per month increases in prices. But people who are talking about high inflation and persistently high inflation and have been telling you to buy gold and silver because inflation is out of control, clearly have been misspeaking. Inflation is not out of control. It's coming down, and that has an effect of causing some investors to back away from buying as much gold and silver. And we saw that in 2022, especially in the second half of the year. And we're seeing that again in early 2023. Another way that inflation affects gold and silver is through interest rates. And again, it's a mixed signal. You've got pockets of inflationary pressures and you've got pockets of disinflationary pressures. And the Fed and other monetary authorities are looking at that and saying, okay, we are in a mixed situation. There are still inflationary pressures that need to be fought. And there also are signs that our interest rate policies and other factors have been turning some of these inflationary patterns around. And not all of the decline in inflation reflects the effects of rising interest rates. There have been other factors in the real economy, supply and demand. Supply chains have been being rebuilt and reestablished, which is why you're seeing the price of goods as opposed to services coming down. But you're seeing increased demand for better wages on the part of service providers. So there's upward pressure on the services side. And that's going to continue. And that creates a situation where monetary authorities will say, okay, we have to continue to fight inflation, partly through raising interest rates, partly through sucking up excess liquidity in the economy by not buying bonds and not replacing bonds that are maturing in our portfolio. But we can also take a little bit of the pressure off of the accelerator, which is why if you look at the FedWatch monitor on the CME Group's website, you'll see that mainstream financial market participants expect the Fed to raise interest rates another 25 basis points in early February and then another 25 basis points in March, and then plateau, and then maybe start declining in November and December, 25 basis points in each month. So the consensus in the mainstream markets, as opposed to the lunatic fringe, is that interest rates Still have some upward movement to go. Uh, get to around 5%, which is what the Fed's been telling people. And then likely to plateau for much of this year. And that reflects another factor, which is the overall economic environment and consequently the stock and bond markets, all of which actually influence investment demand. And you're looking at kind of a continuation of what we've seen in 2022, which is a mixed market and a mixed economy. Some growth, some weakness, some signs of impending recession, some signs that recession may be avoided, at least in 2023 and maybe even longer term. You have special events like the Russian invasion of Ukraine and the bifurcation of the global economy between China on one side and Europe and the United States and other parts of the world on the other side. Those things all will confound economic analyses, but it kind of looks like it's going to be more of the same. And in that kind of environment, you would expect the precious metals prices to be more of the same. So we see gold and silver moving, showing some strength in the first quarter, moving sideways, maybe coming down a little bit in the second and third quarters, and then showing resumed upward pressures in the fourth quarter. That is based on our economic view primarily, also our expectations of investment demand trends for gold and silver, and also the price seasonality of gold and silver. And you can see here, these are the typical variances in monthly average metals prices for gold and silver since 1992, and 1992 through 2021. And you can see strength in January, February, March. In gold, it actually goes into May. Actually, it goes into May, I guess, for silver too. Strength in the first quarter, starts to lower down in the second quarter and third quarters. In the case of gold, it tends to pick up in the final 4 months of the year somewhat. And in the case of silver, it tends to pick up a little bit in September. So our expectations are that the prices of gold and silver will show some strength in the first few months of this year for economic reasons, for political reasons, for financial market reasons, and for the fundamentals of the markets themselves. And then they could cool off and move basically sideways, second and third quarters, sideways to lower as they did in 2022, and then start to rise again in the fourth quarter as economic issues become a little bit more worrisome. How's all that factor in? If we expect the price to do that, and we look at the longer term situation in the world, and we say this is the calm in the eye of the storm, as one of our clients put it, this is not a period of time to sell your gold and silver. You should, if you own physical metal or if you have gold and silver in some other form as a long-term store of savings, store of wealth, alternative asset, portfolio diversifier, you shouldn't probably be selling that. But you could hedge your exposure, if you're an investor, to declining prices on a shorter term basis by purchasing put options or some sort of compound option. CPM Group likes compound options because we don't like to pay retail. We like to pay wholesale prices, and using compound options, you can reduce the cost of buying that insurance. And that's really what you're talking about when you're talking about price risk management. You're talking about price insurance. Keep your physical metal, but buy some insurance so that if the price does fall on a shorter term basis, you can protect the value of your wealth from the decline in the gold and silver. And you can also have the opportunity to generate profits. You buy a put today as insurance of your long-term physical holdings, and the price of gold falls back to 1720 or something. That seemed outrageous a year ago, but was actually realized over the course of the past 12 months, you can sell that put back or unwind that compound option and generate a profit. And the profits can be very large in percentage terms. So by hedging your long physical position, you can protect yourself, buy some insurance against lower prices on a shorter term basis while maintaining your long physical position. And you can profit from the fact that you bought that insurance policy. It's intelligent investing. We'll be coming out with our reports, our annual yearbooks, March, April, and July on gold, silver, and platinum group metals, respectively. You can go to our website and read all about various other reports and services that are available. You can become a retail investor client of ours and buy into our stuff. You can read all about what you can do with CPM Group at our website, cpmgroup.com. I'll see you next week. Take care of yourself and have fun, and take care of the world around you.